Today we're going to look at the closing entry process. And what I have here is a set of books for Jag Elk for 2009. And let's just zero in on this a bit. As you can see, we start with opening balances. Why are there no opening balances here in the sales account or in the cost of sales account or in these various expense accounts? Why do they start out empty? Because our nominal accounts, our revenues, expenses, and dividends, are cleared out each period so that they only have this period's activity in it. And at the end of the period, they're cleared out so that July doesn't include activity from June. Because these accounts are capturing the activity for one period. And so at the end of that period, they're closed out to retained earnings so that they can be fresh for the next period. So at the beginning of January here, they are empty because they were emptied in December. And here are all the activities, all the transactions in 2009 recorded, and we see revenue and expenses. And we get an unadjusted trial balance. What was that? That was the opening plus the activity. So this is before the adjusting entries. Then we move over here, and now we have the adjusting entries. And the adjusting entries are to the accounts you would expect. We're recording bad debt and setting up the allowance for bad debt, and we'll get into that in a later chapter. We are adjusting inventory to the physical count. We are recording prepaids that have been expired. We are accruing in expenses that have not been yet recorded but have been used up. We're accruing in salaries that haven't been paid. We're accruing in taxes that haven't been paid. We are relieving unearned revenue for what was earned during the period. So we've had sort of the greatest hits here, don't we? We see interest expense being accrued in as a journal entry. We see depreciation somewhere. Where is it? No, I don't know why depreciation hasn't been recorded. It looks like it was recorded during the period, and therefore it doesn't have to be recorded as an adjusting entry, which is fine. So then we get this adjusted trial balance, and we would create the financial statement from the adjusted trial balance. And when we were done with that, then we would close out the revenue and expense accounts to retained earnings. And the net of the revenue accounts and all the expense accounts is profit, and the profit is the net amount that gets credited to retained earnings, or if there's loss, it's a debit to retained earnings. And then you have the post-closing trial balance, so all of the revenues and expenses have been emptied out. So the natural balance for revenue is a credit, so to empty it out, you have to debit it. Expenses have a natural debit account, and so you have to credit them to empty them out. So that they're all emptied out now, and the difference between the revenues and expenses was added to retained earnings. And now this is ready to be the opening amount for the new period, just like this was the opening amount for January.